This is the Sunday Business Page on KDKA-TV.
And a very good morning to you. Thanks for spending part of your Sunday morning with us. Investing in the stock market is not for the faint of heart. If we forgot that, we had a rude awakening this past week. CBS's Nikki Battiste has more on what happened on Monday.
The Dow went into a free fall midday, plummeting almost 1,600 points before rebounding some. The big drop comes on the heels of the worst week in the market in more than 2 years and Friday's major sell-off. Economists say investors are nervous about inflation and interest rate hikes.
One of the jobs the Federal Reserve has is to contain inflation when it starts to bubble up. So if we start to see inflation, what the likelihood is the Fed will raise rates faster or more often than we're anticipating.
The Federal Reserve triggered a downtrend early when it hit Wells Fargo Bank with sanctions for opening millions of phony consumer accounts. Wells Fargo fell sharply and other banks followed suit. But last week's good news of jobs and wages picking up, the very things that make for a strong economy, are also what make investors skittish.
Unemployment claims have hit a 45-year low.
Deputy White House Press Secretary Raj Shah said in a statement, markets fluctuate, but the fundamentals of this economy are very strong, and they are headed in the right direction.
You're paid after me.
It was quite a welcome for new Federal Reserve Chairman Jerome Powell, sworn in just hours before the markets started falling. Nikki Battiste, CBS News, New York.
So what can investors do to weather an uncertain time on Wall Street? Well, we're so pleased to welcome George Dukovich, certified financial planner, to the Sunday Business Page. He's president of Dukovich and Associates Financial Services Incorporated and branch manager of the Raymond James Financial Services office in Pittsburgh Strip District. For many years, George hosted the Moneyline program on KQV News Radio until that station went off the air at the end of 2017. George, welcome to the show. It's so good to have you on.
Well, thanks for having me.
And I have a feeling we're going to have you on a lot over the years to come. So, you know, as much as we regret KQV going off the air, we're happy that you're still here and you're with us. So
I know, it's been on there 30 years. It's tough to figure out what to do on my weekends now.
I'm sure it is. I'm sure it is. Well, let me just tell you something I said last week. I said Wall Street is crazy. I mean, it makes no sense because here we are, good jobs numbers, people finally getting wage increases, at least in some parts of America, sure. Bonuses for some. I mean, all of that is good news. But the market, the stock market, takes it as bad news. And that's crazy for most of us.
Well, we have a battle. There's a battle taking place for your money. The battle is the stock market versus the bond market. For years, you probably see it all around, interest rates are very low. Years ago, people would remember interest rates paying 7, 8, 9%. Back in the 80s, you had crazy rates in double digits. Well, all of a sudden, everyone's focused in on the 10-year Treasury and the yield that it's paying. And it's paying about 2.85% for 10 years. That's what you'll make. People remember Christmas clubs paying that kind of money. But in the investment markets now, interest rates are now the focal point because they're seen creeping up. And I think what spooked the market, up like 20 basis points, like from 2.6 to 2.8, and everyone got nervous all of a sudden.
Right. And then you have these institutional computer programs, right?
Right.
Doesn't that mess up the works too?
I personally don't like them because it's computers running money and they just deal with data. It's not you, me, or friends or neighbors calling and say, hey, buy me IBM or sell me IBM. It's a computer running it. Not only that, John, some of these investment vehicles have leverage in them when they're double or triple times. I don't agree with them at all. I don't think I should be part of the market.
Right. Well, they certainly hurt and they accelerate a big fall when it's occurring. Right. So, key question. What do we do about this? Is there anything that the normal investor, and that's, most of us just have money in our 401ks or IRAs. Right. I mean, we're not playing the market every day. So do we just sit back and hope for the best? I mean, what's your advice to people who are watching who are worried that their 401ks are not doing as well as they might or have been?
For most people, sure, you tell them sit back and relax. We do get calls to the office, although we didn't have many. We've been prepping people kind of for this thing. Listen, we've had a good year last year. The market ran up 30%, and some of these stocks went up a whole lot of money. And you tell people, this doesn't happen all the time. So there's going to be some type of correction. And most of these analysts call a correction a 5 to 10% pullback at a value. Right. And that's kind of what we had from the high point of the year to where it closed off. That was about 9-10% pullback.
You know, and I think that's important to restate that, because if you put it in perspective, the market went up so much in 2017 that what we really lost, frankly, was gains in 2018. We still have those gains from 2017, right?
We're doing okay. Sure, we're fine. We're holding a level now, and that's what a lot of the technical people look at now. They draw the charts and graphs, and they're saying, hey, we're holding a technical base. I mean, it's interesting to look at, and you show clients that, but it's a form of technical analysis that most people don't do. But there's a lot of psychology involved. People say, hey, can I still retire? Am I okay taking money out?
Yeah, well, let me ask you about that, because we have a lot of folks who watch this show who may be in their 50s and 60s and looking to retire. Plus, I know we have a lot of viewers who are already retired. I hear from them. So are those folks in special jeopardy? What should they do?
No, I would say they're not in jeopardy. Actually, some of it might end up being good news. If interest rates creep up a little bit, again, there's that battle for your money, stock market versus bond market. If interest rates creep up a little bit, you might be able to find safe investments you're happy with that make enough money to achieve your goal. Your goal for most people, a monthly check, right? If I'm retired, I need a monthly check. So it might not be a bad thing. But if you're in the stock market, you're 50 or so, you're just keep saving. If you're a younger person, don't even look at it. Just save your money and figure out how to save more money, because you're going to need more money down the road.
Right. I think that's the bottom line, is don't look at it, but try to save even more.
Sure.
And if I think it always comes back to whether your portfolio is balanced in the first place.
Right.
So,
well, some years, like if back in the big crash, everyone thought they were balanced, but even bond funds sold off back in the year. Everybody went to cash.
Well, George, it's great to have you on the show. I know we're going to have you back. George Dukovich, thank you, sir, very much for your advice and counsel. We appreciate it. And let's keep riding this roller coaster, but mostly up.
Thank you.
When the Sunday Business Page continues how Key Bank is being a good neighbor to the Upper Hill District through its foundation. The story of neighborhood allies and the